So Matt, last time we talked about life insurance as an asset. And today we're going to spend a little bit more time talking about the different types of assets that you should have and how life insurance plays a role in sort of the diversification of risk in terms of the assets that a doctor would own.
Yeah, totally. I think that's a really good opening for the topic of, well, first and foremost, what are the different buckets of risk when it comes to your, financial portfolio? The way that I like to educate my clients on, describing that risk is in three ways. First, you have like your home run bucket, right? When you think of a home run, doc, you think of swinging for the fences, trying to make as much money as you can. In that bucket, I would typically put, a business, or maybe even in this realm, maybe cryptocurrency, right? But really like a business is your home run bucket. You could become a multimillionaire, or some things happen where it could fold, right? But naturally, your home run bucket takes the most risk. Then you have your aggressive bucket. This is where I tend to see most people, allocate their investments to, right? Your 401ks, your IRAs, you have your stocks, your mutual funds, ETFs, even real estate, right? Aggressive, why? Because, it does take on risk. Some people allocate, higher risk inside of those accounts than others, but naturally they're all associated with risk and volatility, but we anticipate them to go up over time. But as you and I both know, what happened, in 2022, saw really, big down year. So there's risk associated with that aggressive bucket. The third bucket is our safe bucket, right? This is where we have our cash, our checking, savings. Maybe it's money market accounts, CDs, bonds, as we'll talk about, right? This is the bucket that you feel safe in. You feel like you have guarantees. There isn't a lot of volatility. Now, interestingly enough, I'm also going to put whole life or permanent life insurance inside of this category as well. Now, when it comes to the diversification inside of that safe portfolio, I'm going to kind of run through a little role play here with Dr. White just on how we tend to go through our process with our clients. Once I, allocate those buckets and draw out those buckets in front of our clients or our prospects, I'll then ask them the question of, look, Dr. White, if I gave you $1 million a year, how much would, and you're in your upper 30s, right? How much would you allocate to your aggressive or home run bucket? How much would you keep safe?
So usually, when you're in your 30s or early 40s, you do tend to be more aggressive with your investments. You're spending a lot of time on your practice, building it and growing it. For the most part, as far as something conservative, I see most doctors looking at about 20% of their investable assets that they're putting in the safe bucket.
Sure. And when we understand, the investable assets, monthly from a doctor, right? Let's say they're conservatively saving $10,000 a month, after all of their expenses and things are paid off and having their fun and whatnot, right? Or, $10,000 a month. And you tell me you want to save 20% of that, right? Meaning you're saving $2,000 a month, right? So from that situation, I would then say, okay, you and I would both agree that our safe bucket is our least conservative way to make money, right? If I put money in that checking account, how's it going to grow?
It doesn't really these days.
Unless you put money in there more, right? It's not going to grow. So when we look at how do we allocate to our safe bucket, right? We need to understand first and foremost that as we grow and as time evolves, and if I transfer your age from 35, 40 to 55, 60, right? Where do you think those safe dollars would be allocated towards in terms of that risk diversification? Do you feel like you'd want to allocate more of your surplus to those safe dollars, or do you feel like you'd want to be a little bit more aggressive in the same way you feel like you are right now?
Yeah, of course. So most doctors, as they get closer to retirement, the prospect of that steady income from the practice obviously starts to end, and at that point they want something more predictable that doesn't have the risk of going up and down with the market. So what we see is most doctors are looking at 40% or more now becoming assets that are going into that safe bucket.
Exactly. And so when we understand the notion that our safe bucket is our least effective and efficient way to grow our wealth, but we also understand that over time it naturally becomes our most important, right? let's not even talk 50s and 60s. Let's talk 70s and 80s. We're probably not allocating any dollars, unless it's, play around money, to try to really invest in the market. We're probably looking at income annuities at that point and things like that, right? So, at that point in time, we have to understand that even though it's our least efficient, it becomes our most important. Right. And when we evaluate the different areas of our safe bucket, right, the most critical thing to think about is the word safe. And what does the word safe really mean? Well, to me, Dr. White, safe means efficient and it means guaranteed. Efficient in terms of taxes, right? Your safe dollars, you're not going to want to have a big tax burden later on. You're not going to want to pay gains. You're not going to want to, deal with volatility of interest rates, right? When you're dealing with bonds or CDs or anything that's tied to those interest rates, you're taking on those risks. I'd love for you to touch on that too, since that's a big part of your planning as well.
Absolutely. So, in that safe bucket, things that are tied to interest rates can actually change in value. So you might have a CD, and the CD could pay you a certain amount of interest during the period that it is available to you, and then the interest rate resets. So you actually really can't count on that for a period of 10 years, 20 years, 30 years, and so on. And as we see from last year, for example, even bonds tend to change in value because of interest rates rising and falling. So again, that makes them, they seem like they're guaranteed, but the value of those bonds can change and affect the amount of assets you actually have in that safe.
And not only that, Dr. White, I know we just talked about in our aggressive bucket how the market did. If we had a municipal bond, a government bond, U.S. Treasury, whatever it is, how did that do last year?
So all of them actually went down. And that's something that a lot of people aren't prepared for normally, because they think of those types of bonds as being extremely safe. And without going into the details of that and providing investment advice, the general reality is that they do fluctuate in value.
Absolutely. And so when we understand that and we look for other ways to become more guaranteed and to really have those, affirmatives that when we're allocating to our safe dollars, there is no risk of loss, right? There is one way in which we consult our clients to allocate and to account for those safe dollars more effectively and efficiently, which just happens to be permanent life insurance. Now, I'm not going to go into a ton of detail on the constructs of permanent life insurance and what you can guarantee. And I know I talked about permanent life insurance as an asset in one of our previous videos, but understanding how in permanent life insurance, of course, it's an insurance product, right? There is a life insurance component to it. But when you understand that it grows very conservatively in cash with minimum guarantees, it is no matter what, never going to go down. These are things that we have to be considering when it comes to allocating in our safe bucket. And plus, we want to talk about an ROI. I don't care if somebody invests $1 million into the stock market tomorrow. If you have $1 million contribution into your life insurance and you go, croak 6 feet under 3 days from issuing that policy, the ROI is unimaginable based off of what can happen in an additional alternative asset, right? So when we look at comparing our safe dollars, the initial ROI from a liquidity perspective is not great, right? There's a cost of insurance associated. We're not going to sugarcoat it. Our clients are going to feel some pain in the early years as they pay off the insurance. However, in a God forbid situation, there is no better ROI in the world than life insurance in the first couple of years if something were to happen to you. But additionally, as time goes on, right, again, safe bucket long term, when we really educate our clients on how the cash accumulates, how efficient it is from a tax perspective, right? These are things that become extremely intriguing for our clients. And when we map it out versus bonds or CDs or things that have very low interest rate guarantees without the life insurance component even, it really becomes not even a challenge to compare. It really becomes, something that these clients and doctors specifically value very much so in their financial portfolio.
Absolutely. So to recap, you have a asset in that safe bucket that grows tax efficiently. It is not taxed, unlike the interest rate that you would receive from the majority of other safe bucket assets. It grows protected, so it has the same protections as a 401k if there was any issues with creditors and so on. And the other thing that we always talk about is it does create a safe bucket that you can actually use in emergencies. And a lot of doctors forget that, in a 401k, the money that you allocate there, it's stuck there, which is good. It's there for your retirement. But if you have an emergency, you have very limited ways to use that without paying huge fees and penalties. On the other hand, this safe bucket asset that is permanent life insurance allows you to actually borrow against it and have a lot of different ways that you can use it other than just waiting until retirement. And that's the beauty of the construction of it.
Or towards a maturity date in some other of those safe bucket vehicles, right? So I just think there's a lot of power in some of the strategies that we have. And if you're unfamiliar with it, we certainly welcome the opportunity to have an exploratory conversation. Doc, it's not going to be the right fit for everybody, right? But at the very least, if you want to become more educated on it and understand a little bit more about how it works and how can it fit into your financial portfolio. And by the way, if you're somebody that is not very aggressive in nature to begin with, right, and you're just sitting on money and you're checking your savings, it's not doing anything. How can I redeploy this in a conservative manner that doesn't take on interest rate volatility or market-based volatility? These are the types of conversations that Dr. White and I absolutely would like to be having with you.
Absolutely. And the earlier you start having those conversations in your career, the better, because one of the things that Matt alluded to, the cost of insurance, is lowest when you're younger and healthier. So the power of the growth of this safe bucket asset comes from being able to allocate to it earlier rather than later, because then you're leveraging your youth and health to be able to maximize the growth of it down the line.
Absolutely. I think that was very well stated, Dr. White. Thank you so much.